those are some of them. Now, there are a lot of things that you have to read. Well, if I'm saying I'm going to read everything, we are going to delay. So we talk of rendering of services. So the standard actually explain to us what we mean by rendering of services and what example are services that are rendered by government institution, and when to recognize revenue for rendering of such services. So take your time and go to read. When it comes to rendering of services, what are services rendering? What do we mean by service transaction involving rendering of services? And how do we recognize revenue from such services? Example of services rendered by government and when tax revenue should be recognized. For example, take note of the A. A says that amount of revenue can be measured reliably. So once at the end of the day, if the revenue can be measured reliably, then it is probable that we have known these conditions. So please read them carefully and know what we mean by. Then goods and services, sale of goods. Revenue from sale of goods should be recognized when all the following conditions can be satisfied. So the revenue from the rendering of services should be recognized when all the conditions here are satisfied. So when we talk of the goods, then the entity has transferred to the purchaser the significant risk and reward of ownership of the goods. This condition is the same as we have in the private sector, because once the seller has actually transfer the risk and liability of the goods, risk and reward or relating to the assets or the goods to the customer, and the customer has accepted them, then the revenue has been recognized. Then entity retains neither continuing managerial involvement to the degree usually associated with ownership or nor effective control over the goods or services. So if you have already sold the goods and the entity is not having the goods in your control, then, but take notes, we know the same thing in the private sector. If somebody comes to order goods from you and the person make deposits, or he just come to say that I'm buying something, but he deposit his money but has not taken the goods from you, has not taken risk and reward of the goods from you, you cannot say because you have received money, revenue has been recognized. So those are the things you have to take note of. Okay, so take note of that. And then when it comes to the same thing, interest, royalties, and dividend, when to recognize revenue from these things. Okay, yes, revenue arising from the use by others of the entity's assets, yielding interest, royalties, and dividend should be recognized when, one, it is probable that the economic benefit or service potential associated with the transaction will flow to the entity. That's the first condition. The amount of the revenue can be measured reliably. That is the second condition. So revenue should be recognized using the following accounting treatment. Interest should be recognized on the time proportion, on time proportion basis. That takes into account the effective yield on the asset. For example, if the asset has been held for 5 years, then we charge the interest for every year. So every year you recognize that interest as revenue. Royalty should be recognized as earned in accordance with the substance of the relevant agreement. Sometimes royalty depends on the extraction. As for royalty, it may not be based on the fixed amount you'll be paying every year, unlike the rent, unlike the interest. So royalty will be based on the substance of the relevant agreement. If you have said that the royalty should be paid according to the number of whatever units you get from the particular concession that is given to the person, so be it. Then dividend or their equivalent should be recognized when the shareholders or the entity's rights to receive payment is established. So how to disclose those ones has also been given. Take notes and go through that. Now let's look at the recognition of revenue. Recognition of revenue. Recognition of revenue under this standard is grouped into rendering of service, sale of goods, and interest, royalties, and dividend. And so we come to rendering of services. When it comes to housing, for example, rental income from the provision of housing is recognized as the income is earned in accordance with the terms of the tenancy agreement. When it comes to transport, revenue from the fares charged to passengers for the provision of the school transport is recognized as the transportation is provided. So these are things you have to read and know why how we can recognize revenue. So tuition fees and all that. These are government services that we render. When it comes to goods, the same thing. When to recognize revenue from sale of goods, bills and hold sale. So bills and holds, that sales in which delivery is delayed. Sales in which delivery is delayed at the purchaser request, but the purchaser takes title and accepts billing revenue is recognized when the purchaser takes title, provided it is probable that delivery will be made. So when we are talking of bill and hold, there are certain people, they will come buy the goods, you bill them, they accept the billing, agree that they have purchased, and so, but you are holding the goods for them. They have not come for the goods. Once you have billed them and they have actually taken the bill, but you are only holding the goods. These are the conditions. The conditions under which you can recognize revenue. We are saying that sales in which delivery is delayed, because we have billed the customers all right, but the delivery to the customer is delayed at the purchaser's request. It is the customer who has come to buy the thing. You have billed them and they said they will come for it, say 2 weeks time. So you have made your sales, but the customer say that he will come for it a week time. So the delay is from the point of view of the purchaser. In such situation, we are saying that in which delivery is delayed at the purchaser's request, but the purchaser takes title. You see, the purchaser takes title and accept billing revenue, Revenue is recognized when the purchaser takes title, provided it is probable that delivery will be made. So once the purchaser has accepted the billing and has taken title for the goods, but the delay of delivery is from his point of view, we will recognize revenue when it is probable that we will be able to make the delivery. So once the customer anytime he comes, he can come and take his goods, and you have the goods there to deliver, you can recognize your revenue. Okay, so it means that if the customer has requested, has come to ask for the goods and has paid for it, has actually given you the bill and those things, but you have not delivered it, and if the customer comes for his goods, you cannot deliver it, you cannot recognize revenue. That is the issue. The item is on hand, identified, and ready for delivery to the purchaser at the time the sale is recognized. So as at the time the customer is buying, or you have billed him and he has paid for whatever, if you have the goods and everything is ready, except that the customer himself has delayed the delivery, then in that case you can recognize revenue. The purchaser specifically acknowledged the deferred delivery transaction, and the usual payment terms apply. So these are some of the conditions. So goods shipped that one too has its own conditions. Please, you have to read them. There are plenty. We cannot go through them one by one. The same as with regard to what? Revenue from interest, royalties, and dividends. Fees and royalties paid for the use of an entity's asset, such as trademark, patent, software, music rights, record masters, and motion picture films, etc., are normally recognized in accordance with the substance of the transaction. So, as a practical matter, this may be on a straight line basis or over the life of the agreement. So, because if you have, let's say, given the right to somebody to use the copyright or trademark or whatever for a number of years, amount of interest to be charged or royalty to be paid will be based on certain amount of time he uses the thing, and that one, it is the substance of the case that will determine how revenue should be recognized. And so we are saying that as a practical matter, this may be on the straight line, because sometimes it depends on the number of years we are using. So you can look at the royalties on the straight line basis. When a license has the right to use certain technology for a specific period of time, right? So we have an assignment of right for a fixed fee or non-refundable guarantee under a non-cancelable contract, which permits the licensee to exploit those rights freely, and then licensor has no remaining obligation to perform. Is in substance, it's a seal, right? Example of, so you can just, then we have the IPS 23, which is revenue from non-exchange transaction. We said non-exchange transaction is any transaction that is not an exchange transaction. So the objective of this standard, the non-exchange transaction standard, is to prescribe the requirement for the financial reporting of revenue arising from non-exchange transaction other than non-exchange transaction, other than non-exchange transactions that give rise to an entity combination. The standard deals with issues that need to be considered in recognizing and measuring revenue from non-exchange transactions, including identification of contribution from owners. So we are talking of transactions that one do not receive equal consideration. So if you render services and you do not receive equal consideration for that services, or you purchase something, or you receive something and you do not give any amount in equal to that what you have received, it's a non-exchange transaction. So it's more or less one way where donors give you money or taxpayers pay money without giving them the right, the equal transaction in exchange. These are all non-exchange transactions, and in public sector, non-exchange transaction takes a greater part of their activities. So that is what we are talking about. So the scope of this standard: an entity which prepares and presents financial statement under the accrual basis of the accounting shall apply this standard in accounting for revenue for non-exchange transaction. The standard does not apply to any entity combination that is a non-exchange transaction. So take note, where we are talking of the, in fact, International Public Sector Accounting Standard, as adopted by countries that have adopted them, are required to prepare their financial statement using the accrual basis. And so all public entities that is using accrual basis comes under the application of this standard, right? But if it's about business combination, entity combination, that one, any transaction that has to do with business entity combination, it is out of this scope. Definition of some terms in this standard: we have condition on transfer asset. We have condition on transfer asset, control of an asset, and all that. So condition on transfer asset, these are stipulations that specify that the future economic benefit or service potential embodied in the asset is required to be consumed by a recipient as specified, or future economic benefit as specified, or future economic benefit or services potential must be returned to the transferor. You see, most of the times we have foreign entities or foreign donors giving us certain assets, and they come with conditions. Conditions on transfer here is a conditions that stipulate that it's a stipulation that actually specify the future economic benefits or service potential embedded in that asset is how it is required to be consumed. That it comes with that the conditions say that the asset that has been given, whether it is funds, it is whatever thing benefit that has been given to any government entity, it comes with condition. And the condition is that use it the way they have asked you to use it. And if you are unable to use it the way you cannot use it the way they have asked you to use it, you transfer the asset back to the owner, the transferor. You see that is condition on transferred asset. I have given you 10,000 to be used to build school. You can only use it to build school. If you don't have school to build, then return the money back. These are stipulations, and when we say stipulation, they are restrictions. Stipulations are restrictions or conditions that specify that the future economic benefits or service potential embedded in that asset is required to be consumed by the recipient as specified. You are supposed to consume the future economic benefits or service potential of that asset the way the donors have specified, or the future economic benefit or service potential must be returned to the transferor. So if you cannot use it the way it has been specified, then you return that future economic benefit or this into the transferor. That is what we call conditions on transfer assets. Then control of assets. Control of assets arises when the entity can use or otherwise benefit from the asset in pursuit of its objectives and can exclude or otherwise regulate the use of others to that benefit. So control of an asset. Once you have control of an asset, it means that you have the right to use the economic benefit from that asset exclusively, or you have the right to prevent others from using it, or you have the right to regulate the way others can benefit from that asset. It means that you have the control of the asset, right? That's what we mean by control. So exchange transactions are transactions in which one entity receives assets or services or has liability extinguished and directly gives approximately equal value, note of the exchange transaction, primarily in the form of cash, goods, services, or use of asset to another entity in exchange. We have talked about that one already. Now, expenses paid through the tax system. This is an example of non-exchange transaction. Expenses paid through the tax system. Okay, the amount that are available to beneficiaries regardless of whether or not they pay taxes. So the amount that are available to beneficiaries, and the beneficiaries here may be the government institutions, regardless of whether they pay, whether or not they pay taxes. And so once you receive taxpayers' money, whether you pay tax or not, you do not give anything in exchange. That is an example of non-exchange transaction. Fines are also example of non-exchange transaction. So fines are economic benefit or services potential received or receivable by a public sector entity as determined by court or other law enforcement body as consequences of breach of laws or regulation. So if somebody breaches law or regulation and you find a person, you don't give anything in exchange to that person. And it's an example of non-exchange transaction. Non-exchange transaction. So we have talked about exchange transaction. So non-exchange transactions are transactions that are not exchange transaction. In a non-exchange transaction, an entity either receives value for another, receive value from another entity without directly giving approximately equal value in exchange. Please note how to explain the non-exchange transaction. It's a transaction that are non-exchange transaction. Okay, it's a transaction that are not exchange transaction. And in a non-exchange transaction, an entity either receives value from another entity without directly giving approximately equal value in exchange, or gives value to another entity without directly receiving approximately equal value in exchange. And so we have talked about what do you call it? Transfer conditions on transfer assets. Now, this condition on transfer asset gives us restrictions on transfer asset. Restrictions on transfer asset. So restrictions on transfer asset are stipulations that limits or directs the purpose for which a transfer asset may be used, but do not specify that future economic benefit or service potential is required to be returned to the transferor if not deployed as specified. So the difference between restriction on transfer asset and conditions on transfer asset is that for conditions on transfer asset, if the receiver does not use the asset the way it has been specified, then the future economic benefit from that asset must be returned to the transferor. But for restrictions on transfer asset, it is a stipulation that actually limits or directs the way or the purpose for which the transfer asset must be used, but it does not specify that the future economic benefit must be transferred to the transferor. Okay, then we have stipulations on transfer assets. Stipulations on transfer, these are terms in law or regulation or a binding agreement imposed upon the use of transfer asset by entities external to the reporting entity. So stipulation on transfer asset, that's why these are terms in laws or regulation that is or binding agreement between the person transferring the asset and the person having the right to actually use the asset. So that is the stipulation on transfer asset. Then we have tax expenditure. These are potential provisions of tax laws that provide certain taxpayers with concession that are not available to others. And so that these are all non-exchange transactions in the public sector that we are talking about. So we have the tax expenditure, tax event. It's the event that the government or legislature or other authority has determined will be subject to taxation. Any event that will be subject to taxation is tax event. Taxes are economic benefit or services, potential, compulsory, paid to, or paid or payable to public sector entities in accordance with the laws and regulations established to provide revenue to the government. Taxes do not include fines or other penalties imposed for breaches of the law. And remember that taxes that are paid to finance government properties, government development are non-exchange transaction, because we are, even though it is expected that as we pay the taxes, the government should provide certain social amenities for the development of the country, but it is not compulsory, and they cannot give equal in equal. At least when we pay the tax, we are not giving equal benefit or equal return, equal value for what we are paid. Sometimes that's why that's the reason why many people are not even paying the tax, because they're realizing that when we give government the tax, they are not using it to do the things that will benefit our lot. So that is it. It's non-exchange transaction. Then we have transfers. Transfers are inflows of future economic benefits. Transfers are inflows of future economic benefit or services potential from non-exchange. This one is supposed to be non-exchange transactions other than taxes. Any transfer to any government expenditure, any government entity other than taxes is non-exchange transaction. Okay, so we have talked about a non-exchange transaction and how to recognize revenue from it. So you can look at the revenue recognition also in the non-exchange transaction. Stipulations, we have talked about stipulation. You have to read more on them. Conditions on transfer assets. We say conditions on transfer assets here hereafter referred to as conditions require that the entity either consume the future economic benefits or services potential of the asset as specified, or return the future economic benefit or service potential to the transferor in the event that the conditions are not breached. So we have explained this already. So you have to go through. There are a lot of things. Substance over form to the what we mean by taxes. A lot of things. So please just recognition of assets under IPS 1. So please, these ones are all things that if we take our time, read more on them, right? You don't want to stay long. So the questions here are: state the main sources of government revenue. And that's what I think we have to. Main source of government revenue. Have we talked about that? Okay. So taxes and those ones. So you can we are going to talk about that one later. Hello. Thank you. Okay. So we'll talk about the government source of government revenue very soon. So we are talking about the self-assessment question here. State the main source of government revenue. We are going to talk about that one very soon. Explain the difference between revenue and receipts in the public sector. Explain the difference between revenue and receipt in the public sector. Because receipt might not necessarily be revenue. So take notes. Receipt cannot necessarily be revenue. So if you receive money for somebody who have ordered for goods and you have not supplied, that is a receipt, cannot be revenue. Revenue is when the right and reward regarding that particular asset has been transferred to the customer. So explain the recognition of revenue from non-exchange. Explain the recognition of revenue from non-exchange transaction and write short notes on the following accounting regarding International Public Sector Accounting 9, Public Sector Accounting Standard 9 and 23. So we have the exchange transaction. Take note of that one very, very well. The 6 exchange transaction, non-exchange transaction, stipulations, substance over 4. That can be picked for you. That question can be picked for you. So take note of it very well. Discuss the initial analysis of the inflow of resources from non-exchange transaction. So look at the questions and try to. Let's finish with at least session 3 and we can go. So the first question in the self-assessment question was asking of source of government revenue. That's what we are going to talk about now. Revenue and expenditure recognition in the public sector. So by the time we finish going through this unit or this session, you should be able to identify the sources and classification of government revenue, identify the sources and classification of government expenditure, and recognize revenue and expenditure in the public sector. At least this one, if you do not understand anything at all from this unit, at least sources of government revenue, and source of government expenditure, please take notes and understand it so that in the examination you can write something. Okay? So what we talk of government revenue. The government revenue has the constitutional responsibility, or the government of a country has the constitutional responsibility to provide essential services to its citizenry. And all this require huge amount of resources to discharge. Of course, government has a lot of things to do, especially in our part of the world where society has not been developed in future, and any society government that comes has a lot of work to do, except that these our politicians are amassing work for themselves rather than thinking of the citizen. But what the fact is that government has the constitutional responsibility. The Constitution has actually made it clear for every government to actually ensure or provide social essential services to its citizens, and all this require huge amount of money. The government needs money to provide public goods and services. And so public goods and services, when we say public good, we are talking of things that are goods that are made for all. Public goods are things, goods that are made available for every citizen, irrespective of your age, your gender, your tribe, whatever. Okay, so public goods and services such as schools, roads, security, pay compensation to public sector employees, service debts, reduce poverty through social benefits, provide grants and subsidies for consumption, among others. These are things we are all aware. At least at this level, you know that government has the responsibility, constitutional responsibility, to provide essential services and also to provide public good and services to all citizens of Ghana. And this includes social infrastructure, schools, road, transport, security, workers' payment, and a lot. In order to carry out its work, the government must have funds to finance them. In fact, the people we have voted for, they don't come and use their own money. Sometimes some of them, they come very poor. So it's their idea that they are going to use to manage our money. So the government manages our money, right? So all these social amenities, social facility, road, transport, hospital, this things, all that they have to do, the government need money to carry out all this work. This will be possible by ensuring that it has adequate and sufficient funds in the consolidated fund. So for government to do all this, to provide all this social amenity, this can be possible when government makes sure that they have enough funds in the consolidated fund to help ensure or to help execute all these facilities. It has to have a good financial system to generate revenue. Government to have, we are saying that to ensure the adequate and sufficiency of funds, it has to have a good financial system to generate revenue, enough revenue. So government revenues are monies raised or received by the government or on its behalf, arising from its principal business. Sources of government revenue, therefore, includes the following. Government revenues can be examined from can be obtained or can be examined from the different levels. First one is central government, which is the consolidated fund. Then we have the ministry, department, and agencies to meet their commitments. Subvented entities like the schools, like universities and others, then MMDAs. So we have revenue coming from the central government, which goes into the consolidated fund. Revenue from the ministries, departments, and agencies, some of them that they use to meet their commitment, and then some of the subvented entities like universities and institutions that government support. Then we have some of the funds coming from the ministry, the metropolitan, municipal, and these assemblies, and then the state-owned funds, state-owned enterprises. For the purpose of our study, we will concentrate on the central government sources of revenue paid into the consolidated fund. So we have all these areas that we can examine the source of government revenue from, but we are now going to concentrate on the central government monies, that source of the money from the central government. So the main source of revenue to the central government, that is consolidated fund, include the tax revenue and non-tax revenue and grants. So for government source of money into the central government consolidated fund accounts, so consolidated includes tax revenues. And when we talk of tax revenues, we are talking of the direct tax, indirect tax, and then all other taxes, right? Then we have non-tax revenue, that is other tax, we talk about that, and then grants. Now let's take them one by one. For tax revenue to government or to the consolidated fund, these are compulsory levy imposed on the people of the country by a legitimate body or person. So the legitimate body is the parliament, because it is the parliament that has the constitutional mandate to impose taxes on the people of the country, on the citizens of Ghana. Okay. Of course, the taxes may be proposed by the executives, that is the finance minister or whatever, to generate revenue, but it have to be approved by the parliament. So we are saying that taxes are compulsory levy imposed on the people of a country by a legitimate body or person. The tax revenue is basically the revenue the government raises through taxation. Tax revenue is basically the revenue that the government raises through taxation. In Ghana, only parliament can approve. Take note of this particular point. In Ghana, only parliament can approve the imposition of taxes on the people of Ghana. This is contained in Article 174 of the 1992 Constitution. It is only the Parliament of Ghana that can impose taxes on the citizens of Ghana, on the people of Ghana. Taxes can be grouped into direct or indirect taxes. And when we talk of direct taxes, you know. So take note of this. We can be given to write note on this one. What differentiates between direct tax and indirect tax, and give examples of direct tax and indirect tax. These are questions that should be familiar with you. You can write, at least, because if you have done public sector, then you don't know sources of public government revenue, and that becomes a big problem for you. So a direct tax is referred to as taxes levied on persons. Take note of persons' income and persons' income and wealth. Persons' income and wealth paid directly to the government. So the income imposed on persons, and here persons includes corporations, include legal personalities like corporations, companies. So individual workers, private individuals, and the companies, the taxes they pay are direct tax. So yes, it's referred to as tax levied on persons' income and wealth, directly to the government. The tax burden associated with this tax fell on the taxpayer. It is progressive in nature. That is, it increases with an increase in income or wealth. Examples of direct taxing. So taxes imposed on persons' income or wealth is what we call direct tax. Okay, and we are saying that the burden associated with that payment of tax, we call that incident of tax. The incidence of tax, of indirect tax, rests on the taxpayer. So it is the taxpayer that feels the pinch of the tax payment, unlike the indirect tax, where the person paying does not feel the pinch, because at the end of the day, he's going to transfer it to another person. But for direct tax, is the tax levied on people's income or wealth directly, and it is the people paying the tax that feels the incidence of the tax. That is we're talking of the burden, the tax burden, the incidence of the tax. The tax burden is rests actually on the taxpayer, right? Examples of indirect tax include the personal income tax. This we call it pay as you earn. You know more information about that. Pay as you earn. Those of us working, we are paying income tax, and that is what we call pay as you earn. If you're a teacher, you are also paying that income tax. Corporate tax are tax that companies are paying to the government. They pay it on their profits that they earn for each year. Then we have rent tax. If you have a building and you are giving for rent, you are supposed to pay rent tax on your rent. Many of the landlords are not paying anyway because there's no enforcement. But if there's proper enforcement, anybody who has his house and people are renting is supposed to pay tax percentage, and his percentage tax is 15% on the tax, but they are not actually enforcing it. So landlords are getting it free unless the registered estate companies, for them, because they are registered with their registered company, they pay that. But individuals who have their houses, for example, if you come to University of Cape Coast, the villages here, they have a lot of houses that students are, amount of money they are getting, they don't pay anything on it. But it is the law enforcement themselves are not enforcing. So then we have the vehicle income tax, which the vehicle owners pay. We have the capital gain tax. Capital gain tax is a tax that is charged on the difference between the amount you pay for any security, any shares you have bought and the amount you sell it. For example, if you bought a share in a company at, let's say, 5 cedis per share, you have bought 20 or 100 of them, you multiply by that, and then the share price got to, let's say, 25 or 30. Now you sell it off. The difference between how much you bought the share and how much you are selling for is called capital gain. You're supposed to pay tax on it. We have the stamp tax and then dividend tax. All these are indirect tax. These are direct example of direct tax. Then indirect tax these are taxes imposed on people and services. These are taxes imposed on goods and services. The burden of tax fell on the final consumer who consumed the goods and services. You see, so for the indirect tax, it is a tax levied on goods and services that we buy. The taxpayer does not feel the pinch, but the person who is the final consumer is who feel the pinch. So the beer that we are buying, the goods that we are buying, the prices of things that are going up, the sellers do not have problem. The sellers are the payers of the tax, but they don't feel it. They sell it to us, adding the tax element, and we feel the pinch, the final consumers. So take notes. Example of indirect taxes include excise duty, that is taxes imposed on domestic goods. Excise duty are taxes imposed on domestic goods such as beer, polythene bags, and this. That is excise duty. We have import duty, custom duties, and excise duty. The difference between custom duties and excise duty is that excise duties are taxes imposed on domestic goods, okay, and then custom duties are goods taxes imposed on export and import goods, imported and exportation, right? So we have value added tax, which is imposed on chargeable goods and services. Then communication service tax paid on airtime. Then we have this one we haven't included it here because that time when we were doing the book, that e-levy has not come. E-levy is also an example of indirect tax. Yeah, it's also an example of indirect tax. Then we have a custom duty tax, petroleum tax on the petroleum products and services. Then we have non-revenue tax, that is the second source of revenue. This refers to other sources of government revenue apart from taxation. Collection of non-tax revenue is the responsibility of the various agencies or institutions involved in such transactions or services. So tax revenue includes, non-tax revenue includes received from sale of public assets. If government entity sells any public asset, this is a revenue that is from non-tax, that is non-tax. Then user fees and charges for services such as passport fees, academic facility fees, academic facility user fees, DVLA charges, and etc. All these are revenue that are non-tax revenue. Okay. Interest, dividend, royalties, and profit from government-directed investment. So if government entity has any investment in any company or has any asset that is hired by another company for which we are receiving interest, dividend, or royalties, those revenues are part of the central government revenue that are paid into the consolidated fund. Then we have royalties on natural resources. Mining companies, they pay royalty. This example of non-tax revenue. Rent income. Rent income. This one is not rent tax. Rent income, that is where government institutions have built, or government has built houses or affordable houses, and people are occupying and they are paying rent. This is non-tax revenue. Then sale of goods such as gold, cocoa, and all these product, timber, and all this that we sell, that also brings revenue, and it is non-tax revenue. All this goes into the consolidated fund. Then the next one we are talking about is grants. Grant is also an example of government revenue. Of course, these are financial assistance received freely by a government from another bilateral, from either bilateral or multilateral sources. When we say bilateral, we mean the agreement between Ghana and another country, so two countries. So if, for example, China agreed to give us a grant of an amount to build our roads, that is a revenue. That is a bilateral arrangement. Multilateral is where IMF, or let's say World Bank, or this thing is giving us, or a lot of nations coming together helping us, more than one country helping, giving you grants. So grants coming from World Bank, International Monetary Fund, and then all that is multilateral source. So we're saying that these are financial assistance received freely by a government from either a bilateral or multilateral sources without any requirement of repayment to support its operations. So if any country support Ghana by giving us a grant or giving us money without we paying back, that is different from loans. The grants are different from loans. Take notes. Bilateral grants are those grants received from other government, whereas multilateral grants are received from international agencies such as the International Monetary Fund, the World Bank. Grants are usually in the form of money, though some types of grants may offer access to resources, services, goods, or other aid. So grants are usually in the form of money, though some type of grants may offer access to resource or service. Sometimes they give you services, not in the form of money. Sometimes they give you goods or they give you other things in aid. Grants are often given to fund a specific project and require some level of compliance and reporting. That's why we are saying that is non-exchange transaction, and therefore sometimes it comes with restrictions, conditions, and stipulations. Right now, government expenditure. The items of government expenditure. Government expenditure comprises all expenses incurred by the central government. So we are talking of government, central government expenditure or expenditure charged to the consolidated fund. Government expenditure comprises all expenses incurred by central governments, the local governments, and other public sector entities for the delivery of public services. So government expenditure can be classified into statutory and discretionary. Remember that in the consolidated fund, we said there are two conditions under which money can be taken from the consolidated, either from statutory expenses or discretionary expenses, right? So for statutory expenditure, these are expenses or expenditure charged on the consolidated fund. So statutory expenditure, these are expenditure charged. So please take note that I can give you this very question to explain or to differentiate between statutory expenditure and discretionary expenditure. You can, it's a good test for you to actually differentiate between statutory expenditure and discretionary expenditure. So we are saying that the statutory expenditure, these are expenditures charged on the consolidated fund by the Constitution or by an act of parliament. They are regarded as statutory obligations and therefore do not require prior approval of parliament. Take note, those statutory expenditures that are charged to the Constitution, to the consolidated fund by the Constitution, money taken for such expenditure does not require pre-approval of parliament. Example of statutory expenditure are debt servicing. That is charged to constitutional consolidated fund and therefore does not require pre-approval of parliament. Parliament must agree, must be known that this money is taken from for that purpose because it has already been charged to constitutional what do you call it? The consolidated fund already. Pension payment does not need prior approval of parliament. Emolument of certain public officers, there are Article 175 public officers like the Auditor General, the President, those people, their salaries are charged to the consolidated fund, so they don't need parliamentary approval. So they normally they are charged by dollar equivalent, and so you pay them according to the dollar equivalent. You don't need to, seek parliamentary approval for them. I hope you are with me. Hello.
Yes, Doc.
Yes, please. Right. So that's what we are saying. That is the statutory expenditure. Okay. Example of statutory expenditure, we are saying that debt servicing, pension payment, emolument of certain public officers, such as the Auditor General, transfer to statutory fund, such as District Assembly Common Fund, 5% of the total tax quarterly. Social Security contribution, that all these are amount charged to the consolidated fund that are statutory, right? Then we have the discretionary expenditure. These are expenditure that requires parliamentary approval before authorization can be given. For the discretionary expenditure, the Ministry of Finance must submit to Parliament for it to be approved before money can be given for that expenditure. They are also known as non-statutory expenditure. The government has control over the decision to incur such expenses. Okay, because that one, they have to bring it for approval. Government of Ghana expenditure classification has been revolving. Okay, so expenditure classification in the public sector accounts has been changing, right? We have different classification of the public sector expenditure. So take note of this. It's a Government of Ghana expenditure classification has been revolving over time. So according to the chart of accounts, a created list of accounts used by an organization to define each class of item for which money or the equivalent is spent or received. That is the chart of account. That chart of account is a created list of accounts used by organization to actually define each classes of items for which money or equivalent is spent or received. So that chart of account. Expenditure can be classified as follows. So under the chart of account, the expenditure could be classified as follows. So we have 1A, the MTEF. The MTEF classification can be as follows. First, the MTEF expenditure framework. That is medium-term expenditure framework, MTEF classification. This was in use from 1999 to 2011. So from 1999 to 2011, we were using the MTEF classification of expenses. That is the medium-term expenditure framework classification of expenses. That was what we were using. It was in use from 1999 to 2011. Under the MTEF, discretionary expenditure was classified into one, the personal emolument. And so this personal emolument is a compensation to employees of government. So we put all compensation to employees of government into one item called personal emolument. Then the next item was administrative costs. This is the cost of running government establishment to provide public services. So all expenditure incurred in running government machinery in order to provide various services that the government is providing, the running of government offices in provision of its services is put together as what? The administrative cost. Then we have the service cost. This is supposed to be highlighted. Service cost. Service costs incurred. It's a cost incurred in providing general public services. It's a cost incurred, or it was all costs incurred in providing general public services and or providing the capacity of entities to deliver more efficient services is put together to call service costs. So the cost incurred in providing general public services, okay, and all improving the capacity of entities to deliver more efficient services, all of them put together as the service cost. Then we have the investment cost. Investment expenses, these are expenses on the construction or acquisition of capital assets. So investment cost here was made up of all costs incurred in construction and acquisition of capital asset. So if government buys shares in another company, if government build roads, transport, build a bridge, all those things put together was investment, right? So that was the classification by MTEF, that is medium-term expenditure framework classification, which was in use from 1999 to 2011. Now, second one is the integrated financial management information system, GIFMIX. GIFMIX came to be in place from 2012. So from 2012 up to date, we have been applying the GIFMIX classification of government expenditure. GIFMIX, that is Ghana Integrated Financial Management Information System. That is an information system that government is using to prepare its accounts. Okay, and the Public Financial Management Act was actually give back into this particular system of government accounting. And so under the GIFMIX classification, the revenue are grouped under first and that has been in use from 2012 to date. And this is a current system of expenditure classification in Ghana with the prime objective to improve the effectiveness of service delivery and allocation of scarce resources. Under the GIFMIX, expenditure are put into 8 categories. Take note. Under the GIFMIX, expenditure are put into 8 categories. And remember that under the MTEF, it was 4. Under the MTEF, the classification were 4, just 4. But just that a lot of things were put together: personal emolument, administrative costs, service costs, and then investment. Now, under the gift mix, we have 8. The first one is compensation for employees, and it's like the first one, personal emolument. This is made up personal emolument and all allowances payable to employees. Then we have goods and services. That should be highlighted. It is a combination of administrative costs and service costs. So for goods and services, we put the administrative costs of managing the public offices and the service costs as outlined in the MTEF in item 1 and item 2 and 3 together to give the service, goods and services. Then we have computation of fixed capital. Consumption of fixed capital. So consumption of fixed capital here, it measures the portions of non-current asset. And when we talk of non-current asset, I know what you mean by non-current asset. Asset that will be in use of the organization for more than one accounting period. They are non-current assets. Therefore, when we spend on those assets, it is put under consumption of fixed capital. It measures the portion of non-current assets consumed within an accounting period. Example is, okay, so the consumption of fixed asset is not the fixed asset itself. It's not the acquisition of the fixed asset. It is the use of the fixed asset. So the expenditure, the amount of that fixed asset that has been consumed for the period. So example of it is depreciation of non-current asset. So the consumption of fixed asset is more or less depreciation charge for the period, right? Because it measures the portion of the non-current asset consumed within an accounting period. So it's more or less a depreciation charge for the period, and it's a depreciation of non-current asset. Then we have public interest. Public interest here, this is made up of interest on domestic debts and external debts. So because government debt must be serviced, and so interest will pay on government debt, and this is made up of the interest paid on both domestic debt and external debt. Okay, domestic debt are interest paid to treasury bill holders, the bond holders, and those things in the country, and then those foreign bonds that we have issued, the interest we pay put together gives you public interest. The next one is subsidies. Subsidies here, this refers to all subsidies to both private sector and public sector. Subsidies are monies given to public institutions, both public and private institutions, to actually assist them do something. I mean, enhance their operations or whatever. It's an assistance government gives to. Okay. So then we have grants. So there's difference between actually assistance and subsidies. So we shall talk about that one. Grants. This refers to government assistance. Okay, so the difference, you see, we are now looking at difference between subsidies and grants. The subsidy refers to all subsidies to both private sector and the public sector. And then the grants refers to government assistance to other entities, other countries. Okay, government assistance to other countries or the local government. Then we have social benefits. These are such expenses on social security, such as national insurance, national health insurance, school feeding, all the social amenities. Now we have the free HSS, school feeding. We have the LEAP, a lot of all social interventions. Amount of money we spend on these social interventions is called social benefits. Then we have other expenses. Other expenses includes contingent expenses and other expenses which do not fall under any of the 7 groups. So look at this classification very well, because when it comes to preparing the central bank account, we are going to look at the classification of the revenues and the expenses, right? So It is now 9:13. The last time when we got to 9 something, you wanted to go. So let me find out from you, do we go or we continue? So that, but again, this weekend, though I won't go for the invigilation, but my grandmother is going to be laid to rest this weekend. So Saturday, I may have to attend the funeral. But what I will do is that, I don't know if you can even let us meet earlier by 6 o'clock. So at least by 8, we have covered about 3 hours before I go. Or if we start at 7, we'll do up to the 9, then I will go. Because if I don't go for my mother's funeral and my grandmother's funeral, it's going to be a problem. So that is my concern. So that if we do about, we start at 6, we can do up to 9, 3 hours. Then Sunday after church, which will be around 12, there when my is not meeting you, I can meet you again. Then we collect, because I have to go for the church service too. He's not a Muslim. I'm a Muslim, but she is not. So I will have to attend the church too. So, but in the afternoon we can still meet. That's on Sunday. So Saturday, depending on how you agree, if you can we can meet at 6 o'clock to 9, so that I can just go for the funeral. If you still insist at 7, we can make the 2 hours, and then Sunday we continue to finish. But it is now 9, and I don't know. Hello.
Hello, sir.
Yes. So, Iman, are you there? What do you suggest?
I suggest for today it's 9 o'clock. We close today and continue on Saturday 7 o'clock. Then we close at 9 so that you can attend the funeral. Then Sunday we meet you, as you said earlier.
Okay. All right. All right. Then that is the deal.
Okay.
Thank you. Thank you. So once we're able to finish 4 units, unit 5 and 6, we'll see what we can do. If we don't get there, I'll set my questions at where I get to. All right. Thank you. But I will send you this time too. I'll send you tutorial questions, provided you go through.
Okay, sir.
Right. Thank you so much for your time.
You're welcome, sir.
But any problem, any clarification, if any of you having difficulty with what we explained?
Oh, Doc, all is well.
We thank God. So the material is with you. Try to sit down and make your own notes. And then if you have any difficulty, please let me know. Don't go to sit in the examination room without knowing anything. It's not good. Okay, right. So let me end here. Then we meet on Saturday, 7 o'clock tonight.
Thank you, Doc.
Welcome.